So we've had another pullback in the markets. After Elon Musk was bashing Bitcoin for its lack of energy efficiency, Binance being accused of money laundering, now Tether may be one of the reasons why Bitcoin's price is going the other way. Stay tuned. Welcome back to another episode of your Digital Hustle News. So, in this video, guys, we're going to take a look at a very interesting thread from Avanti Digital CEO Caitlin Long, because she indicates a quite interesting reason as to the reason why we're in the current state of events that we are in when it comes to the market. Now, we all know that Elon Musk has been taking to Twitter in response to Bitcoin's lack of energy efficiency, as well as Binance being under fire for money laundering activities. But Tether has also revealed this week the content of some of their holdings. Now, we're going to jump over to this thread real quick, analyze their report real fast. Now, as you can see, there's 75%, their largest holding, is in cash and cash equivalents and other short-term deposits and commercial paper. That which we know. That was reported back in January, I believe. Another 12.5% is in secure loans, none to affiliated entities. Another 9% to corporate bonds, funds, and precious metals, and another 1% in other investments, including digital tokens. Now, a breakdown of this 75%, you have commercial paper, fiduciary deposits, only 3% of that is in cash. Then you have reverse repo notes and treasury bills. But why is only 3% of that in cash? Ms. Caitlin Long is going to go into it on this thread. I'm going to run through this as quickly as I can, but I want to highlight the important pieces. So, first, Tether finally disclosed how it invests reserves, and it was a big negative surprise. This news probably contributed a lot to the crypto sell-off on Wednesday. Why? Because now risk managers at crypto hedge funds almost certainly will require haircuts on Tether, which means traders had to sell crypto to reduce their total risk exposure. For example, if risk managers now apply 5 to 10% haircut for Tether, and Tether is in a trader's portfolio, the trader must bring down total exposure by selling other non-Tether cryptos. Based on Tether's new disclosure, both Tether's probability of default and loss severity in default just went up. Why? Because of credit risk. Now, there's now much bigger risk that Tether may break the buck, trade below par to the US dollar amid a credit market correction. This would probably bring crypto markets lower. If that happens, DeFi protocols that have already cut Tether would be proven right. The markets have already had independent confirmation that Tether had very little bank deposits in its reserves, but now we know its reserves are mostly embedded in credit assets of who knows what quality, not T-bills or other short-term, lower-risk liquid securities. So, simply put, guys, Tether's money isn't Tether's money. And that was the biggest question that we were trying to ask at the beginning of the year. Where does this money come from? Is it legit? Now we're seeing that it's basically credit. So, continuing, Tether's reserve portfolio looks like a credit hedge fund with some interest rate risk, corporate bonds, and commodities risk thrown in too. Needs a lot more disclosure, so many new questions. So, a big question is why? Why choose to take so much risk with users' reserves? Tether's reserves issues used to be partly explainable banking access but Tether clearly has securities access now. Doing this was a choice. Tether has securities access now. Like I alluded to in my State of Crypto video, guys, I really feel like cryptos being listed, registered as securities might be unavoidable depending on the type of project that it is, which I think is going to be bullish long term, bearish in the short term, but it's unavoidable. Okay. Now, going forward, she says that she's always challenged the business model of some stablecoin issuers, mainly because of their reserves. Now, here are some math on Tether's 58.2 billion of reserves. A conservative assumption is that Tether's reserve portfolio yields at least 1%. That's 582 million of annualized profits going to Tether's issuer. I can only guess how U.S. regulators reacted to Tether's announcement. She says, tread carefully. I've thought for a while that a stablecoin crackdown is inevitable. Will this trigger it? Now, this is interesting. 1% of their Tether reserves are actually backed one-to-one to the US dollar. With Tether being the most circulated stablecoin in the cryptocurrency market right now, that would cause other stablecoins like USDC, TrueUSD, Binance USD, PAX, it would cause more attention that way. This, to me, seems like a slow, methodical breakdown of Tether. It's a slow, methodical breakdown, like another narrative that streams right along in with XRP versus the SEC, Elon Musk versus BTC. It all plays into part, guys, because, and yeah, she's going to go down into this a little bit further. Stablecoins are going to play a very important role when it comes to the shift because they are the direct replacement to the US dollar, guys. They're going to be the direct replacement. Okay. So with that being said, they need to shake the basket with all of these stablecoins. All right. The New York Attorney General, when she made that proclamation for them, gave them this mandate that we're seeing play out now. Like I said in the video, they own Tether, and they're going to use Tether for all of the little things they need to use it for. And if they have to use it as an example of how much they can control the stablecoin market, they will. Now, getting back into this thread because there's more juicy information. Let's get back to it. If or when, a crackdown happens, I'll be shaking my head because some of the fallout would have entirely been avoidable if Tether had just invested its reserves in actual money. She regularly defended Tether and will continue to, as it is a very important technology and key industry infrastructure as a bridge to the US dollar, and have relationships with some of its team for going back years. Now, like it or not, one of the best things for this industry at present would be getting stablecoins to be okay with US regulators, especially the Fed and the SEC. And this is when she gets, I like this section because she gets to painting a kind of picture of what the stablecoin economy is going to look like. Now, remember, guys, she's got 22 years of experience in this. She's the CEO of her own digital bank. If it's anybody that knows where we're going, it might be Miss Caitlin Long. So, like she said, like it or not, one of the best things for the industry at present would be to get stablecoins to be okay with U.S. regulators, and especially the Fed and the SEC. Why? Because every U.S. dollar must clear through a bank. and then the Fed. Like it or not, U.S. regulators have big power over stable coins. Wyoming, SPDI laws can't play shenanigans with reserves backing stablecoins because SPDIs can't take risk with customer deposits. Using money is not an SPDI's plaything. Markets will probably soon have an opportunity to vote with their feet, and I suspect money will move to SPDIs, which could become reserve managed utilities for the stablecoin industry. Simply put, the SPDIs are special institutions. Okay, this was instituted in Hawaii. So, if you're familiar with what's going on, not Hawaii, Wyoming, if you're familiar with what's going on in Wyoming, guys, they have created basically the first official crypto bank, right? That's what the SPDI is. It's one of the first official crypto banks, and they would serve as essentially the new Bank of America's, Comerica's, Capital, Huntington's, your credit unions. That is what they're going to look like when it comes from stablecoins. We'll still have your legacy banks around issuing stablecoins, but this is going to be the first wave. So she continues to say that, folks, balance sheets matter. And it's not just whether reserves are 100% or not, it's also risk in those reserves, i.e. credit, interest rates, and other kinds. Wyoming's SPDIs were designed as solvency and played this equally true for crypto custody as stablecoin reserves. Now, speaking of regulators, something pretty big happened this week, and it only got a little attention. A United States bank announced that it will be issuing a stablecoin. That I didn't even know. Gonna have to look deeper into that myself. But Facebook also announced their pilot for Diem, along with Silvergate, where Silvergate will be the issuer and Diem will operate its smart contract. It's a pilot, but it's significant because Diem will be a bank-issued stablecoin. She says Diem, Facebook Diem, will be a bank-issued stablecoin. There will be a lot of blowback towards Facebook, but it's bank-issued. We know this, guys. Take note of that. We know this now. Follow Kate Long on Twitter. But essentially, guys, the last question she proposed is, will the rent-a-bank charter model be used by fintech lenders? And will it be used for stablecoin issuers? So, essentially, will these exchanges, Coinbase, Binance, KuCoin, Kraken, Crypto.com, etc., will they go to these banks and essentially rent out their computer systems to issue out stablecoins? These are just questions that she has proposed, but guys, this is the direction that we're headed when it comes to the stablecoin issue. Now, those at the top understand what this means. It would make sense that they are already moving their money around in preparation for what's to come. Okay? A lot of crypto YouTubers will tell you right now that the end of this bull cycle, not the whole market, but the end of this current cycle that we're in, that began around the end of September, is looking to end the beginning of September of this year. Smart word of advice would be to come out in August, maybe even the end of July. If Ethereum has a breakout because of the EIP 1559, that's a breakout, and it touches like 10 or 11, I'm out of there. I love you guys, but I'll see you later. I'll come back in after the correction, but yeah. Those are just my opinions though, guys. But wanted to share this with you because if Tether fails, And notice the wording. If Tether fails, crypto will fall. It won't be over. It won't be over because we know the long game, guys, the overall narrative, where this is going. It's going to be the money of the future, the currency of the future. We know this. But along the way, there are going to be dips. There are going to be dips. That's why they've come up with terms called like HODL, hold on for dear life, because there are going to be dips as we make this transition to the fourth industrial revolution. But with that being said, guys, that's really it for this video. Just wanted to give you some added hindsight. You know, as I always do, make sure you leave here with more information than when you arrived. And stable coins are going to be an important issue going forward. All right. But there's a lot of great places where you can get stable coins right now, where you can hold your stable coins. And they act one-to-one with the US dollar, and you can get high interest returns on a lot of platforms. Okay. I got a link to those platforms on my site, digitalhustlenews.io. So make sure you guys go and check that out. Some very helpful tools on there. I'm also updating the section where I talk about the taxes and how they're changing, because that's going to be very important too. I might do a video about that. Yeah, it's very important. But with that being said, guys, that's all the info I got for this video. Make sure, don't forget to hit the like button and subscribe. And as always, thanks for coming back to the channel. We are rumbling 1,300 subscribers, guys. I didn't think this was gonna happen. I am grateful that it did happen. But yeah, that's what I tell you at the end of every video. Have a great day. Have a prosperous day. Most importantly, make that money. I'll see you in the next video.